Ladies and gentlemen, good day and welcome to Pitti Engineering conference call for discussing the acquisition of Bagadia Chaitra Industries Private Limited. Joining us on the call today are Mr. Akshay S. Pitti, Vice Chairman and Managing Director, along with the senior management team of the company. Before we begin, I would like to mention that some of the statements made in today's call may be forward-looking in nature and may involve risks and uncertainties. For a list of such considerations, please refer to the earnings presentation. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Akshay Pitti. Thank you, and over to you, sir.
Good evening and a warm welcome to everyone on the call. Before we move to the Q&A session, I'll walk you through the acquisition, touch upon the highlights of the entity being acquired, and the synergies it will bring to the consolidated business. Pitti Engineering signed the definitive agreement to acquire 100% of the equity share capital of Bagadia Chaitra Industries Private Limited on 11th March. A historic day for our industry, as this is the first such M&A in the lamination space. The entity's enterprise value was rupees 124.92 crores as of 31st March 2023. The consideration payable on the closing date shall be the enterprise value adjusted for net debt and net working capital changes from the agreed baseline of 31st March 23. Further, the purchaser shall compensate for the capital expenditure and CWIP at the time of closing. The entity operates out of Tumkur district, Karnataka, where it set up a lean and modern manufacturing facility in 2019. The facility's installed capacity is 18,000 tons per annum. The acquired entity applies its products to various end-user industries, including alternator, motor, and pump. Majority of its sales and the smaller size laminations and assemblies. It achieved a turnover of rupees 264 crores, earned an EBITDA of rupees 14.11 crores and a PAT of 6.19 crores for the year 23. As you know, we are in the process of reorganizing Pitti Engineering manufacturing capacities, concentrating all of our 72,000 ton motor and generator components business capacity in Aurangabad. Furthermore, with the impending merger of Pitti Castings, Hyderabad will become the vertically integrated center for all our machine components business. This acquisition will give us a strategically important manufacturing base in Bangalore, one of the largest consumption centers of motor and generator components in South India. Further, its proximity to Coimbatore, Chennai and Hubli will result in lower logistical cost and improved customer serviceability in the region. The entity is estimated to end with sales of 14,000 tons for FY24. As part of our realigning of productions, we will move approximately 4,000 tons of annual production from Bangalore to Aurangabad and about 6,000 tons from Aurangabad to Bangalore. This will help significantly lower logistical cost on a consolidated basis. Typically, in the lamination industry, material costs are about 80% of total cost. Any savings here have outsized positive impact on the margins. As you're aware, Pitti Engineering predominantly manufactures large size lamination. The addition of smaller size products from this acquisition will enable better raw material utilization on a consolidated basis. As this concludes our brief on the acquisition and the synergies it brings, we will now move to the Q&A session. Thank you.
Thank you very much. We'll now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and one to ask the question. Ladies and gentlemen, you may press star and one to ask the question. The first question is from the line of Piyush Jain, individual investor. Please go ahead. Piyush, may I request you to unmute your line and go ahead with your question, please?
Yeah. Am I audible?
Yes.
Yeah. Yeah. Hi. Thanks for the opportunity. I just want to understand the objective behind this acquisition. Is it something the facility of the target company or the client customer, as we have said that we will get to penetration in South market? So just wanted to understand the whole idea, because when we see this company is having a EBITDA margin of around, let's say, maybe a very suboptimal level as compared to the Pitti. So just wanted to understand the thought.
Yeah. So there are multiple reasons that this acquisition makes sense for us. If you see, as you rightly noted, the company's EBITDA margins are vastly lower than our margins. With the addition of this company in our product portfolio, the improved raw material utilization will enable us to significantly increase the EBITDA margins of that entity. In addition to that, since we are moving our entire lamination manufacturing base to Aurangabad in Maharashtra, we wanted to still have a presence of manufacturing in south of India to lower the logistical cost. So if you see the 10,000 tons of relocation of production base, that will yield another significant saving in terms of logistical cost. So on a consolidated basis, this acquisition makes a lot of sense and will be extremely margin accretive.
But when a company is having a very suboptimal EBITDA, I believe it is around the EBITDA number is something around maybe a 5-6% or something. Then aren't we paying a valuation high? Because I believe we are paying some 8 to 10x of EV EBITDA something number.
For the year 23, the raw material prices were higher, therefore the EBITDA margin looks lower in percentage terms. If you see historically, that company has been able to achieve between 6.5 to 7% EBITDA when the raw material prices are normal. So as the raw material prices normalize, we'll get back to that level. We are paying more for the capacity and the volume of business that they are doing, which is about 14,000 tons of ready business, and the type of business that they are doing, which is complementary to our material utilization.
Okay. So as I understood, they have a capacity of around 18,000 metric tons, correct?
Yes.
So how much revenue this 18,000 metric ton can generate?
So this 18,000 metric ton will typically generate about 300 crores of top line on the current raw material price basis.
Okay. So and any idea in the current year, 6 months or 9 months number, if you can just give some information related to, because as you said, the 2013-23 margin was subdued. So any color on the current year EBITDA number?
So we have the H1 numbers of that entity. They are at about 6% EBITDA margin, and the EBITDA margin is continuing to improve as a percentage of sale as the raw material prices continue to decline.
Okay. So as I understood from you, so the growth opportunity with this 18,000 ton will be limited because the company is already doing 260 odd crores, and you are saying 18,000 ton can do a 300 plus crore or maybe 300 something. So the growth from here will be limited. So I didn't understand exactly how this will help the Pitti or what synergy this can bring. As you said, this entity's margin will improve, but what it will bring a synergy to Pitti, I am still unable to understand.
See, so first is dealing the turnover and the tonnage. The turnover which I'm suggesting is in the looking forward basis. If you see in terms of tonnage, they have done about 14,000 tons of production and they have a capacity of 18,000 tons. So we have about 4,000 tons of surplus capacity available in that particular location in Bangalore. We are doing two things. One, we are reorganizing the business to the right location. From our Aurangabad facilities, we ship about 6,000 tons of material to Bangalore and its surrounding regions, which has a great logistical cost. So that will be relocated to Bangalore, and vice versa. The entity that we have acquired ships about 4,000 tons to Maharashtra and further north. So by relocating these two businesses to the right location of consumption centers, it will reduce logistical costs, which will enable margin growth. Secondly, the type of product that this company makes, which is a smaller product, it helps us in better utilization of raw material at a corporate level. We make larger laminations wherein the side splits are scrap for us. So that scrap will become the raw material for this entity's production. So your overall material cost will go down on a consolidated basis, which will increase your margin.
Okay. So this target entity is, sales will not be a captive goods for Pitti, correct? This will be again be sold to the end customer only, correct?
Yeah, it will be for the end customer only.
Okay. And we believe this margin will be expanded in line with what the Pitti is doing, maybe around the 13, 14%, 15% type of margin in a year's time.
See, our margin is also a factor of the machine components. This entity does not have machine component, neither does any other lamination manufacturer have. So it will not come in line with something like what our margins are. They may improve to maybe about 10% EBITDA margin on 300 crores of sales, roughly about 30 crores.
Okay. So they don't have a machining capacity, they don't have a lamination capacity.
They have a lamination capacity, they don't have machining capacity.
Okay.
Machining is typically used in the bigger assemblies and more complicated products, not in the simpler type of laminations and assemblies that they do.
Okay. And one more thing, I think we have already approved this, the merger of Pitti Casting also, correct? So where this stands now, and how much is the top line or the EBITDA perspective, say, that can be added to the Pitti Engineering's balance sheet in P&L?
So the timeline for the merger is as follows. On 22nd March, we have a shareholder meeting to approve, to consider and approve the transaction. Post that, I believe it takes about 2.5 months for the final effect to be given, depending on the approvals. As far as what we expect, it will add to our profitability. For current year, for FY24, we are estimating about 20 crores EBITDA in that Pitti Casting.
Okay. And just last question, because of this acquisition, are we getting into any client-based acquisition or something? Is there anything else we are getting in other than the capacity and the regional, what you said, the saving of logistics cost and so on?
So if you see, we don't cater to the pump industry today as an end user market. So that will give us a presence into that. The company that we are acquiring, about 35-40% of the revenues come from the pump segment. And that's a huge business segment that we don't operate in. So that segment will further add going forward more sales to us.
Okay. And the last thing, do we want to do any expansion in this segment where we want to cater pumps, home appliances, or EV segment, and to increase this capacity from 18,000 to maybe whatever X number? I know it's too early to ask, but still, is there any vision and thought process behind this?
Most certainly we'll be doing that. So if you see, firstly, Pitti Engineering, the 72,000 ton capacity that we are creating, we estimate full capacity utilization in FY26. Something similar will be there in the Bangalore location, where they are currently doing 14,000 tons. As a result of these tonnages moving around, maybe that facility will be at full utilization by middle of FY26 itself. So around that time, we should be looking at expanding into a new facility, a large facility in Bangalore, and think about something like a 35,000 ton capacity in Bangalore.
Okay.
With a focus on the lower product segments such as pump and home appliances, which are very, very strong consumption centers in Coimbatore and in Bangalore port.
Okay. And what is the thought process on this debt? Because our debt is increasing and we are still in the capex mode, research, which also we are doing, and I think 40 crore we are infusing. And further, with, I think, it is the EV of 120 odd crores, there would be some debt which also coming to our Pitti. So what is expecting our peak debt for 2024 or 25? And then what is our plan to reduce the debt to reduce the interest cost?
So if you see, with this acquisition, we are going with debt to fund this acquisition. Our peak debt will be about 460 crores as a result of this acquisition. After that, we are not having any additional capex plans till middle of FY26. So the cash accrual in this period should be, in my view, sufficient to ensure that we are nearly debt-free in that same time period.
Debt-free by?
By 26.
So are you saying 450 odd crore debt we will reduce in 2 years' time? I don't think so we have that much of cash
Almost
happening.
Almost, it will be. If you see from Pitti Casting merger itself, like I said, they are doing about 20 crores EBITDA. That company has no debt in its books and therefore no interest cost. Similarly, the entity that we are acquiring now, this Karnataka company, we are estimating the EBITDA to go to about 30 crores. And organically, the growth that we are seeing in our business, we should be generating about 200 crores of cash flow annually. So in the 2 years' time, we should be nearly debt-free.
Okay. So then just last one thing. Do we have any pending CapEx in current year or maybe FY 25 or something which is ongoing, or we are about to spend some CapEx
So
via
for FY25, I think about 40-45 crores of CapEx would be there. And that kind of CapEx would be ongoing on a regular basis. Those are small incremental CapExes. They are not large projects that we are taking on.
Okay. To sum up on the debt and debt-free status, are you saying the 40, 45, 50 crore CapEx would be there in the next 2 years? I assume by FY 26 also there will not be much CapEx, debt-laden CapEx. Yeah? And with the... Hello?
Yeah, your audio is not very clear. I'm sorry, I can't hear you.
Yeah. I'll repeat again. I understood from you, by FY 26 there is hardly much debt-laden CapEx is there. And with this acquisition also, we will be peaking out as our debt of 450 to 500 crore, which we expect the synergy with Pitti Casting merger, with this acquisition cash flow coming in, with Pitti Engineering, whatever generating, maybe 2 years timeline, we will be able to get debt free or maybe a type of 100 crore type of debt number. Is that understanding
Correct.
what I understood from you is correct?
Absolutely correct.
Perfect. Thank you. Thank you so much for detailed reply. Thank you so much.
Thank you. Next question is from the line of Ravindranath Nayak from Sunidhi Securities. Please go ahead.
Hello. Thank you for the opportunity, sir. Actually, can you please tell me what is the volume number for FY22 and FY23 for this company that we are acquiring?
So FY22 was about 12,000 tons, and FY21, I don't have the volume numbers.
23, I am talking 23.
23 was 12,000 tons.
Okay. So that means, the EBITDA per ton is around 11,758 rupees. So you said about this, this year, you will be finishing this year with 30 crores of EBITDA. If I listen correctly.
Not this year. After the acquisition is completed and we get the synergy benefits of raw material utilization between our existing products and that company's products, we estimate the EBITDA to move to about 30 crores. There's two savings. There's one on the logistical cost and the second on the better utilization of raw materials.
Okay. So last year they did around 1,400 crores of EBITDA, and you are expecting at least 15 crores or 1,500 crores or 1,600 crores of EBITDA. Then rest would be the savings.
Sorry, I can't hear you and you're not clear.
I'm saying that this year you said about the volume would be around 14,400 tons for this year. And if I say around, there is some increase in the EBITDA per ton, it is around 1,500 to 1,600 crores, 16 crores, then the rest would be savings.
Correct.
So that means...
So let me rephrase. They will do about 16,000 tons next year from their end user segments. That should yield them about 16-17 crores EBITDA. And the remaining 12-13 crores will come from the synergy benefits.
Okay. And lastly, can you please tell me what is the industry bifurcation of revenue, particularly if you mentioned about the pump industry, and what are the other industry? It is largely consumer durables or any other industry also?
No, so see, 30 to 40% is coming from pump industry. About 40% is coming from alternators, and the remaining 20% is coming from general home appliances, those kind of stuff.
Okay. Whether we're planning any further capital expenditure in this business or...
So we will review that. Like I said, we'll review that in FY26. So far, with the expansion in Pitti Engineering in Aurangabad and this acquisition, and the reorganizing that we have to do between Bangalore and Hyderabad facilities, we think we have enough capacity to see us till FY26. For FY27 targets, which we'll start working next year, we may look at CapEx in FY26 if required.
Okay. So we are not going to do any QIP for this acquisition, right?
Right now, I cannot comment on anything like that. This acquisition primarily today is being funded by debt.
Okay. So there is no...
On any fundraising, I'm not allowed to comment.
Okay. Thank you.
Thank you. Next question is from the line of Akash Singhania from Art Ventures. Please go ahead. Akash, may I request you to unmute and go ahead with your question, please?
Yeah, hi. Congratulations, Akshay, on this strategic acquisition.
Thank you, Akash.
I have two questions. So first, let's say if we would have acquired a greenfield facility in Bangalore, Karnataka, with the similar capacity in terms of lamination and land, so how much would it have costed us? Just any ballpark number?
Just the capital expenditure in land, building and machinery would have been at today's pricing about 50 odd crores. If you see the company that we acquired, their picture said gross block is about 30 odd crores as is.
Okay.
And if you adjust it for inflation, to set up such a facility today would cost about 50 crores.
Okay. And do we have land over there to, let's say, increase the capacity post FY26 in case we intend to increase over there? So do we have infrastructure or land available for brownfield expansion?
No, this facility does not unfortunately have any land available for brownfield. If we have to expand there, we have to do a greenfield expansion, which you would anyways prefer, as you would like to create a bigger, much larger facility going forward beyond FY26. Okay. There's sufficient industrial land available in and around the same industrial park that this facility is located in.
Okay. And do we intend to put machining facility as well in this plant, or we'll continue with laminations only?
So we will transfer some of our machining facility from our existing Hyderabad and Aurangabad facility, which will complement the tonnage move from Aurangabad to Bangalore. Okay. There is no intention to do pure machine components in Bangalore as of now.
Okay. Understood. Thanks so much. I think it was very clear, and I think a brilliant acquisition leading to a consolidation of the industry. I think a first of its kind in the laminate industry, and any consolidation augurs very well. So congratulations and thank you, Akshay. Thank you.
Thank you.
Thank you. Next question is from the line of Sanjeev from Dreamland Investments. Please go ahead. Sanjeev, sorry, but there's a lot of static from your line. Sanjeev, if you can hear us, I'll request you to rejoin the queue, or can you disconnect and reconnect the call? There's a lot of static from your line. We'll move to the next participant. Next question is from the line of Bala Subramaniam from Arihant Capital. Please go ahead.
Congratulations, sir, for this acquisition. And my first question is for this company, sir.
Sorry, Bala Subramaniam, your voice is not very clear.
So, what is the debt and cash levels?
So, the debt as of 31st March 23 was about 29 crores in the entity. In terms of cash, I think there are about 8 crores of cash and cash equivalents in the entity.
Okay, sir. So, you talked about 12 to 13 crores comes from synergy benefits. So, what kind of synergies we have in terms of raw material and others?
So it's basically from the utilization of the coil. If you see the raw material, it comes in a form of 1200 millimeters with standard coil. We make the larger lamination, wherein if you're making any lamination more than 800, you cannot typically use the remaining side slit for anything equivalent to 800, obviously. So this company makes laminations just smaller in diameter, so we can utilize these raw material coils in a much better way to derive synergies on the overall material cost.
Okay, so any other synergies, sir? Yes, sir.
Secondly, like I already mentioned, there are synergies in terms of logistics cost. and from our Aurangabad facility, typically ship about 6,000 tons of material to Bangalore, which after this acquisition will be produced in Bangalore and sold in Bangalore. Vice versa, the company that we are acquiring ships about 4,000 tons of material towards the north. That would be made in Aurangabad, and the logistical cost savings should be significant also in that.
Got it, sir. Got it.
So these are the two major financial synergies. Apart from that, obviously, the economies of scale kick in, your purchase benefit comes in. If you are buying a significant quantity of raw material, you have a outsized impact on the supply chain side, thereby reducing material costs. You'll have faster product development cycles. So the non-financial synergies also are many in nature, which we cannot quantify right now.
Got it, sir. Got it. So this current capacity, 18,000 tons, post FY26, like we are adding 30 to 35K tons. It's a nearby place, right, sir? That factory?
See, we are not adding. I'm saying if the market supports us, we may choose to then expand the Bangalore facility rather than the Aurangabad facility at that particular point of time.
Okay, sir. We got it. Thank you, sir.
Thank you. Next question is from Sanjeev Zarbade from Dreamland Investments. Please go ahead.
Yes, sir. Sir, I think you have already answered about the nature of the small motors market. I just wanted to know how large.
Sorry, I lost you there in between. I can't hear you.
So the line for the participant dropped. We'll move to the next participant. Next question is from the line of Prathamesh from Motilal Oswal. Please go ahead.
Oh, hi, I'm audible.
Yeah, you're audible. Please proceed.
Yeah. Hi, Akshay. So my question is, first you mentioned that some of the machining expertise would be transferred to Bangalore. So would it be fair to assume that there will be improvement in realization per ton for the Bagadia facility?
So see, we will be moving our business to the Bagadia facility and Bagadia's business to our facility. At the end of the day, this will be a WOS. So the right way to look at it as a consolidated basis, what is the margin? It's not like we are improving the margin of his business by moving some machining. His business does not require any machining. We are moving those products which is being manufactured in Aurangabad, which require certain amount of machining, to Bangalore for better cost optimization on transportation.
Okay, so like you mentioned that 6,000 tons would be moving from Aurangabad, so the big laminations would be moving there and small lamination would be moving from Bangalore to Aurangabad. Is it fair to assume?
Yes. So we will, it's not just about size, it's about where the eventual consumption of that particular product is. So those would be realigned to save logistical cost. And whatever complementary facilities are required to do these productions would be moved. It may be that some machines may move if required.
Okay, understood. So you've mentioned RM cost as well as logistics cost being one of the levers towards EBITDA improvement. Would, let's say, salaries, employee benefits would also be a lever going forward which would improve EBITDA margins on the company level or at Bagadia level?
So, see, obviously with the more business, the overhead will be spread wider. So that indirect benefit we'll anyways get. As far as, any employee cost rationalization at the Bagadia entity level, I don't see much potential there as they are very lean operation, as I had mentioned in my introduction.
Okay.
So there's not much scope for doing that there.
Okay, understood. And could you please give us more color on the type of clients? Like you've mentioned that these are basically small laminations, but are the clients, who would the clients be if you were to give a couple of names that Bagadia caters to?
Yeah, so they are smaller in size, but in terms of end application, they still go into the alternator space, the motor and the pump. So on the pump side, Texmo Pumps is one of the largest clients. Then they have a company called Nidec, erstwhile Leroy Somos, which is a major client. And to some extent, about 20 or 25% of their revenue overlaps with our clients as well, on the smaller end of their product requirements.
Okay, so would there be client concentration at Bagadia's side? If we were to see pumps at 30%, but then on the overall level, as far as clients are considered?
Sorry?
as far as client concentration is considered, customer concentration, how would the top 5 or top 2 customers account for Bagadia?
So for FY21, top 3 accounted about 57%, and in FY24, H1 FY24, top 3 was about 70%.
Oh, okay. And topmost would be 30% again, if we were to see?
Yes.
Okay, understood. That's all from my side.
Thank you. Next question is from the line of Sanjay Zarbade from Dreamlander. Please go ahead.
Yes, sir. My question was regarding the market size of the small motors. Could you take us through that, sir?
Small and large motor put together, like we say, is about a 700,000 ton RM equivalent market. With this acquisition, we should be reaching somewhere around 90,000 tons to 100,000 tons of EC consumption. So post this acquisition, from the small and large both put together, we are around 12-13% of the overall Indian market.
In value terms, how large would be the small motors market?
In value terms, see, this is not just motors that this company is making. If you see the lamination that they sell to Nidec, it's also for power generators. So it would be very difficult to, kind of correlate that with this acquisition. As far as the small motors market is concerned, apart from the appliance and pump, I believe, based on whatever we understand from our customers, this is about a 5,000 to 6,000 crore market. There's a small one. Other than pumps, alternators, and home appliances.
Okay, great. And sir, is it possible for any outsourcing opportunities from, let's say, the established small pumps makers, where we can, deliver small motors for their pumps? Any such opportunities or scope for such opportunities there?
I think it is too premature for me to individually comment on this, as we have just gotten into this acquisition. Once we get more interaction happening with the end customers and understanding their requirements, I'll be in a better position to comment on that.
Okay, sir. Thank you.
Thank you. Next question is from the line of Khushbu Gandhi from Share India Securities. Please go ahead.
Yeah, so one question from my end. How do we see ourselves in the next 2 to 3 years in the lamination capacity? Because right now we are extending 72,000 plus this 18,000. So any more expansion are we looking in this?
So till FY26, which is the next 2 years, we are not planning any additional capacity. We first need to start utilizing this capacity to its most optimum utilization. For FY27, we will take a call next year how the market is rolling out and then look at investment requirements.
Okay. And so in the lamination for the new acquisition where we have done, is this fully automated like what we have done in the Aurangabad facility, or this is semi-automated?
So I would say that 70% of their production comes from highly automated processes because they are smaller lamination. Little bit of the mid and large size lamination that this facility does do comes from manual operation.
Okay. So any plans for revamping or for automations over there?
Right now, there's nothing planned. Maybe in the operational capex that we keep doing, like I said, 40-45 crores, we do have a budget for the next 2 years, each year. Maybe in that, we may take up some of that.
Okay. Are we going to do any of the sales of this pumps and alternators to exports, or this is purely domestic?
So the pump and the alternator that this company is manufacturing is purely domestic. They do have exports. I believe it's about 8 or 10% of revenue is exports, mainly to Europe.
Okay. So do we have plans to increase our exports over there, or this ratio will continue going forward?
See, this entire turnover will obviously get consolidated. It will become a WOS, and we will reorganize the business to its right location. So there is no inherent benefit in doing the exports from Bangalore. it would be most appropriate if that exports sales are moved to our Aurangabad facility, where we can utilize the raw material in a much better manner and also help reduce our logistical costs by freeing up capacity in Bangalore to do our legacy Pitti Engineering business in Bangalore. So we will be doing those reorganizing between the facilities. We are not seeing these as two different companies. We are seeing this as facilities of the same parent company, which is Pitti Engineering.
Yeah. So my point was that, are we looking for exports in the alternators and the pumps to increase going forward, or the ratio will be the same for this?
It will continue the same, I would say.
It will be the same. And any idea on what is the order book currently which we have for Bagadia, or?
Just 1 second. I believe it's about 120 crores.
120 crores. Okay, so yeah, that's it from my side. Thank you.
Thank you. Next question is from the line of Akash Jain from Money Curves Investments. Please go ahead.
Yeah. Hi, Akshay. Thank you for patiently answering so many questions from investors. I think I just heard a small clipping on a news channel that you had given, where you had broadly guided that FY26 at 70% utilization for all three combined companies. You are expecting a 1,700 crore revenue and around 17% EBITDA margin. So one is, broadly, does that number sound right? Also, I want to understand for FY26, not really a guidance, but if you achieve full capacity utilization across the three companies, what kind of revenues and margins are you expecting for FY26? Very broad guidance. That was part one of the question. Part two of the question was also, sorry, you can continue.
Yeah, so if I have to break it up so that you can better understand what we are trying to say, if you see the 1,700 crore top line, that's a factor of the current sales price per ton of Pitti Engineering multiplied by the guided sales tonnage for FY25. We are adding the turnover which will accrue from the acquisition as well as the merger of Pitti Casting. In terms of margin profile, if you would see, we have guided to about 48,000 EBITDA per ton in Pitti Engineering. So that into the tonnage plus the EBITDA that will accrue with the synergy benefits from Bagadia takes us to about 17% on a consolidated basis EBITDA for FY25.
Yes.
Now, if you just extrapolate these numbers forward,
Yeah.
if you just extrapolate these numbers forward for FY26, and again, this is a very basic and rough guidance, if I am call it that, would be that, Bagadia business would kind of saturate at the 30 crore EBITDA post synergy basis. And obviously the machine components is growing in Pitti Engineering, and the tonnage in Pitti Engineering will expand to about 56,000 tons, which would be around the peak utilization of our capacity in Aurangabad. And at that point of time, we'll be looking at about 50,000 EBITDA per ton in Pitti Engineering. So on a consolidated basis of all three businesses, we should be looking at about 350 to 360 crores EBITDA, less about 35 crores of the incentive income from Maharashtra state government.
Okay. And just one quick refresh question, Akshay. So post the merger with Pitti Casting, what will be the total outstanding new shares? Because some dilution will happen for the Pitti Engineering shareholders. So just a refresh for us.
Approximately it's about 22 lakh shares which is being issued, and the total share capital should become about 3.42 crore shares.
Okay. Thank you so much. Thank you so much.
Thank you. Next question is from the line of Karan Kamdar from DR Choksi. Please go ahead.
Hello. Hi, Akshay. Congratulations on the great acquisition. So I was, maybe this question is already answered. I don't really know. So the EBITDA margin in the press release is about 5%, if I'm right, for the Bagadia entity. So what I wanted to understand is how would we grow to 17% or 14% which we are guiding for Pitti?
So you see, Pitti Engineering, we are currently at about 15% EBITDA. If you add Pitti Castings post merger, that's for current year itself, we're doing about 20 crores of EBITDA. in terms of sales, if you cancel out the sales to Pitti Engineering, it will add about 50 to 60 crores only to the top line. So that itself, kind of takes you to a pretty high EBITDA number. And if you add Bagadia Chaitra along with its synergy benefits, that will give about 30 crores of EBITDA. And for next year, we are talking all of this for next year. Next year, we also have volume growth in Pitti Engineering as well as EBITDA per ton growth. So all these factors put together, we are estimating about 17% EBITDA margin on 1,700 crores of top line.
Hello?
Hello?
Hello? Yeah, I lost a little bit of this. Can you repeat? Sorry. Last part, just last.
So all the three factors put together, the merger of Pitti Casting, which will add about 20 crores on a FY24 basis in terms of EBITDA. The synergy benefits accrued in Bagadia Chaitra will add about 30 crores of EBITDA. Apart from that, the EBITDA per ton in Pitti Engineering also, we have guided as about 48,000 tons for FY25 on about 50,000 tons of sales. So if you, kind of total these on a consolidated basis, that takes us to about 290, 295 crores of EBITDA, which works out to about 17% on 1,700 crores of top line.
Okay, got it. So my question was more on the lines of percentage tons or EBITDA per ton for the Bagadia entity. Will it improve or will it get in line with the Pitti concern level, or will it stay at a lower level like it currently is for FY23?
So it will continue to remain at a lower level. The right way to look at this would be, if you take Pitti also, we have a blended EBITDA per ton. It's not like all of our businesses are hitting that same EBITDA number. Some are punching way above the average and some are punching below the average. So Bagadia legacy business should yield about 15,000 or 18,000 rupees per ton EBITDA. And then you have the synergy benefits on transportation, which will bridge the gap on the movement from 17 odd crores EBITDA in Bagadia to about 30 crores on a consolidated basis.
Okay, got it. Understood. Thank you so much, sir. Thank you.
Thank you. Next question is from the line of Pulkit Singhal from Dalmus Capital. Please go ahead.
Thank you for the opportunity and congrats on a good acquisition. Just curious about a couple of things. One is when I compare the working capital cycle of Pitti versus Bagadia, I see quite a bit of difference if you can help explain. So for instance, Pitti has 64 days debtor days, whereas Bagadia is around 37. And similarly, inventory days is 85 for Pitti, whereas Bagadia is at 25. So can you explain what explains this difference?
So, Pulkit, you have to see it in two ways. One, Bagadia doesn't have significant exports. Our exports actually require us to give a longer credit time to customers, plainly due to the transit time. Secondly, the nature of business. They are predominantly into the pump and alternative business down south, wherein the credit cycles to the customers are around 35-40 days. So that explains the difference in the debtor days. Coming to inventory, they use about 2 different grades or 3 different grades of raw material, which are pretty standard in nature. We have a highly complex suite of products, and we have to maintain inventories on multiple grades and types of raw materials. In addition to that, if you see, we are also doing the machining and machine components, which further adds to our requirement of inventories and the lead times that are there for procuring these materials and actually processing them.
Okay. And to that extent, your debtor and inventory days going ahead next 2-3 years because you share of exports as it goes up and machining goes up, this will be on an increasing trend, or is there any guidance you can give for just your business?
On the export side, if the ratio of export is to domestic alters dramatically in favor of exports, then it will mean a deterioration on debtor days. But if the exports go up and the domestic business in Pitti Engineering goes up more than the export, in fact, you'll see a reduction in the debtor days. As far as the inventory is concerned, with this acquisition, we estimate that we'll be able to, in fact, reduce our consolidated inventory days. Like I mentioned, one of the key factors on this acquisition is the better utilization of material. That's not only in terms of the utilization of the slit raw material, but also in the utilization of the inventory that Pitti carries. Because today I have to, kind of store those 5 strips to be used for my smaller laminations, which are few when compared to my large. With this acquisition, we'll be able to flow that material through to this entity for immediate consumption.
Okay. So what is the consolidated inventory days you expect to happen for 1,700 crores of sales that you're kind of thinking about?
It's too early to give you a definitive answer, but it will be net positive only for us.
Okay. In terms of the sourcing benefits, there are two aspects to it. One is that you are able to utilize the sheets better because of using the smaller lamination. But I'm also trying to understand the scale benefits, which is there. So as you're able to add, say, if you're able to source larger number of lamination of electrical steel, how much is that benefit that you get? Because you could have organically also grown at a certain rate of adding 8 to 10,000 tons. So do we have much of benefit on sourcing as you continue growing or adding 8 to 10,000 tons, or that's just a minuscule amount in decimals?
See, our raw material pricing when compared to our peers and competitors is slightly better, and that will not further improve as a result of the acquisition, but most certainly our better price will be applied to any entity that we own. Therefore, we should be directly able to positively impact the earnings of the entity acquired.
Understood. Okay, so the question really is, okay, so if you are at, say, 40,000 tons, and if you were to, production, or say 50,000 tons, and if you are going to, say, 1 lakh tons at some point, 2-3 years down the line, your current negotiation, how much better can you do on pricing? Is it like 0.5%, 1%, or that's just too high in this for the commodity?
See, I think based on where we already are, maybe 0.5% or so would be a fair assumption. It would be par for the course, but anything beyond that would be not possible, given where we already are in terms of raw material price.
Understood. And lastly, in terms of the capacity of 18,000 tons, and you mentioning that you can go to 16,000 tons. When you look at Pitti itself, you always operated at 50% tonnage.
Yes.
So how come in this case we are talking about 90% utilization, etc.?
So if you have to see the type of products, Pulkit, we do those larger products which require multiple operations through those notching process and the gang sorting process. There the number of changeovers become higher, and therefore your setup time increases. The number of setups and the setup time increases. This facility, like we said, is highly automated. They do most of the production through the progressive tooling, wherein you put the coil and you take out the finished product directly from the machine, as you have seen in our factory. So there, the utilization percentages are always much, much higher. What we see as 80% is the average of all our different types of manufacturing processes.
Understood.
If you look at Pitti Engineering's own progressive line, the utilizable capacity is closer to 90-95% in that, subject to not having too many models and tooling changes.
Understood. And this acquisition is allowing you entry into the lower end segment, smaller segment, and I understand you're consolidating the industry as well. But if I just ask you 3-4 years out, are there any plans to get into higher technology segments, for instance, or looking in that direction of the value chain, whether it be in terms of new products or where the kind of work involves more R&D and technology? Is that something which you have as part of the plan?
So right now, Pulkit, once we finish this, if you have to look at the other end of the spectrum, it would be to kind of give a wound stator and ready-to-use rotors to our clients, and that is something which we are actively working on. But we are cognizant of the fact that we don't want to load ourselves with too much debt. I think this acquisition, is where I'm max comfortable. I would not want to go beyond this. But once we kind of ease out our net debt position over the next couple of quarters, we will look at those initiatives.
Understood. Good. Great. Thank you and all the best.
Thanks, Pulkit.
Thank you. Next question is from the line of Prathamesh from Motilal Oswal. Please go ahead.
Hi, I'm audible.
Yes.
Hi. Actually, so my question was, you've mentioned earlier that the acquisition has been funded with debt, right?
Yes.
So, as of September 23, September latest balance sheet which is available with us, we had cash sitting on our books of 114 crores. Why didn't we utilize some of that cash, or maybe to pay existing debt, or maybe to fund this acquisition?
So see, we have the cash on our books, but we also report the net debt numbers. So if you look at the net debt, we were at about 300 crores of net debt. We had some capex that is still needed to be completed in the current quarter, plus the current quarter's earnings, and then the outflow that we make for this acquisition. So our net debt will balloon to 450. After the acquisition also, we should be sitting at about 100 crores of cash available, but the net debt would have ballooned to 450. And that's a number where I would like to kind of pause. I would not want to go beyond that number.
Okay. So post the acquisition completes, the focus would be on deleveraging the business, right? As you mentioned.
Correct. To reduce our net debt.
Reduce the net debt. And so you had mentioned by FY26 we would be net debt zero or debt zero?
Net debt zero. I mean, effectively it's the same thing. We would have equivalent cash line. Whatever debt we would have equivalent cash line.
Okay. Okay, understood. And any would the Bagadia acquisition help us with entry into electrical vehicles, two-wheelers, or other moped that we see around in the market?
I don't think that would additionally help us. Having a location in Bangalore may enable us to cater to those industries in the southern market. As it is, we have a strong brand reputation in the country for laminations, and we are working with, as you know, many two-wheelers and four-wheeler companies on product development right now.
Okay.
So, if an opportunity presents itself for the southern Indian market, we can use that facility to better service those locations. That's about it.
Okay, understood. So, like you mentioned, the laminations capacity for, let's say, the smaller components, is there any number in mind for Pitti's existing businesses? What would be the domestic requirement for laminations across India and, let's say, 3 years down the line?
I didn't understand your question. I'm sorry.
You mentioned in the call, right, 7 lakh tons per annum is required for smaller components, laminations for smaller components?
It's not smaller. It is all components other than automotive, including motors, generators, pumps, railways. The whole industry size is about 700,000 tons other than automotive.
Okay. Okay, understood. And how is it growing? How do you see it growing next 3 or 5 years?
So, each end user segment grows at a different rate, but at an overall level, we are looking at the industry growing at about 10 to 15% CAGR.
Volume CAGR, right?
Yes, volume CAGR.
Okay, understood. And how much would auto would be there? How much auto would account for?
See, we have recently gotten into this whole automotive side of the business due to the push in EV. I don't have definitive data that I can today share with you. We are still trying to understand these numbers.
Okay, understood. That's all from my side.
Yeah.
Thank you. Next question is from the line of Ramchandran. Individual investor, please go ahead.
Hey, hi. Thank you so much. I hope you're able to hear me. And Akshay, congratulations. I think that's a fantastic acquisition and a bold move.
Thank you so much.
My question actually to you is, when you consolidate the engineering, the casting business, and also now this recent acquisition, what do you expect the overall turnover to be by, let's say, financial year 25?
So for FY25, we are estimating about 1,700 crores of top line.
And if I heard you correctly earlier, you said the EBITDA margin is expected to be at around 17%. Is that correct?
Yes, that's correct.
Okay. All right. And also, you also said that you're reorganizing your business between Aurangabad and the one in Bangalore, where I think from 4,000 tons, you're trying to move to Aurangabad and 6,000 to Bangalore. That basically means that out of an 18,000 capacity, you would be doing about 16,000. Is that understanding correct?
Yes. It is yes and no both, because see, there will be certain equipment that we'll also have to move from Aurangabad to Bangalore to service that. So the capacities are fungible between the both locations, depending on the type of product. The way we are actually looking at it is that we have a consolidated capacity of 90,000, and we would be producing and selling roughly about 16 to 17,000 in Bangalore and the remaining in Aurangabad, by reorganizing the equipment in the two locations to most optimally reduce our logistical costs.
Okay, understood. Just one more question. You're talking about from an industry size of around 700,000 tons, and you said, I know if you factor in the acquisition, you would be at around 90,000. You also mentioned that you expect the industry to grow at around 10 to 15%. If I have to extrapolate that 2 years down the line, we're looking at about 1 million ton. At 1 million, will Pitti be 90,000 of 1 million, or do you expect that 90,000 to also go up to maintain a market share of around 12 to 14%?
So, see, from a mission and vision standpoint, we would like to firstly envision ourselves as about 20-25% of the industry. That is our aspiration, to become 25% of the industry, both organically and inorganically. The key lever to get to that number would be inorganic growth further in the future. So let's see how that plays out. Definitely, we would not be at 90,000. I can assure you on that.
I mean, fair enough. I think that's, you inspire a lot of confidence about when it comes to the future of this company. The point being, you're also talking about, you want to kind of manage your debt level at around 450 crores, yet you also want to expand beyond 90,000. How is that going to play out? Because I expect in future, if you're going to, let's say, fund another good acquisition, would that be funded from internal accruals, or would you be then considering to add on a little bit more debt?
So, see, 450 crores is actually a number that comes as about 1.5 times of forward cash generation. That is kind of the benchmarking that we are doing. 1.5 times of forward EBITDA is what we are comfortable as a net debt number. So today that number stands at 450 crores. Tomorrow it can increase also. Secondly, we have very strong cash accrual happening in the company. More so once we consolidate the Pitti castings with Pitti Engineering as well as this acquisition. We estimate about 200 odd crores of PAT plus debt for next financial year on a conservative estimate. And of course, that number will grow in FY26. So today, if you see our capacities, we are well placed till FY26 sales targets that the company has set itself. Now, beyond that, we would look at investments in FY26 or FY27 targets. So by then, automatically, the net debt number would have come down due to the cash accrual. And also, our appetite on net debt would have gone up as a result of increased cash EBITDA per year. So a combination of both of those would kind of enable us to go ahead with further acquisitions as and when the opportunity presents themselves.
Thank you so much, Akshay. Wonderful about this acquisition, and best wishes for more such acquisitions in time to come.
Thank you.
Thank you. Next question is from the line of Ankit Kothari, individual investor. Please go ahead.
Hello.
Go ahead, you're audible.
Okay. Hi, thanks for the opportunity. Most of my questions have already been asked. I have just one question. You said there will be huge saving in the logistical cost. So is there any number how much the savings would be there in the Pitti's P&L and how much savings would be in the combined P&L?
So see, I can tell you the number on a combined basis. If you take the transportation cost between Aurangabad and Bangalore, we should be able to save roughly about 3,000 rupees a ton, and we plan to, at the gross level, relocate about 10,000 tons. So you can kind of get an idea of the logistical cost saving.
Right. Okay. And you said there will be in the Aurangabad facility, the scrap would be used as a raw material for the Bangalore facility. So how much savings would be there? I mean, whatever you will realize from the sale of the scrap, and if a Bangalore facility has to buy the same as in raw material. So any number, I mean, if it has been worked on?
See, See, it's not exactly scrap. It's basically what we classify as byproduct of our slitting process. So when we take the full coil, which is about 1200 millimeters in width, we have to utilize that full coil to the most optimum level. So today, if you see, we sell about 1,500 tons of byproduct slit coils, as we call them. So those byproduct slit coils, instead of being sold in the market at a lower cost, would directly be used as raw material in our target company, which is the Bagadia Chaitra.
Right.
And the cost difference there would be about 7,000 to 8,000 rupees a ton.
Okay.
So that around gets you about 10 odd crores worth of money. So if you see 3 crores from the logistical and 10 odd crores from this, added to his 17 crores of EBITDA is basically the ballpark 30 crores that we had kind of guided to.
Okay, that would be in the combined P&L of the both entities.
Yes. So the benefit would obviously incur once you consolidate both the entities. So we are not looking at these as two different companies, right? This is going to become a wholly owned subsidiary. So at the end of the day, all the benefits are on a consol basis. Some benefit will accrue on that legal entity's P&L, some would incur on our P&L. And see, eventually our view would be again subject to board approvals and members' approvals, consolidate that company into the list co. You would not want to have multiple legal entities operating. It is much cleaner to have one single corporate structure.
Got it. Okay, got it. I got my answer.
Thank you very much. I would now like to thank on behalf of Pitti Engineering Limited for joining the call. For any further information or visiting the plant, please be in touch with Mr. Raman Naidu from Intellect IR on 9920209623. On behalf of Pitti Engineering Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.